It is Friday, June the 13th. Also, it's Friday the 13th. Oh my. If we haven't met, my name is Chelsea Winstead. I am a home financing strategist and a mortgage lender. My goal here on TikTok is to give you digestible information every day on what is going on with rates, what we're seeing with the housing market, and how to navigate buying a home in 2025. I am specifically licensed on the East Coast. So if you are looking to buy this year and you want to have someone in your back pocket who is a strategist, who pays attention to what is going on in the world, and who ultimately will have a conversation with you that feels very personalized and one-to-one, I would love to support you. My DMs are always open, and the link on my profile, you can submit a connection request form and I will reach out to you personally to kick things off. Okay, so let's talk. So 30-year fixed conventional mortgage rate today is sitting right at about 6.89%. Somebody asked me the other day to add in the 15-year conventional rate. We are seeing today that rate is about 6.25%. I don't see a ton of people doing 15-year conventional options, but thought I would add it in. Our FHA 30-year fixed is sitting around 6.75%. For the VA loan, we're at about 6.65%. USDA loan, this isn't actually always listed daily, but a couple people have asked me to. This typically tracks in line with FHA or VA loan. So we're sitting at about a 6.5% on average. One thing that you should know is that most of these rates actually include some type of point buy down. Minimum is about a half a point, discount point, all the way up to 1.5 points. I will say this, I did a whole video on this. I'm going to do some talking on this specifically, but so VA loans in particular, I find that there are a lot of lending institutions that are quite predatory. What I mean by that is they market that their rate is like 5.99%, but when you look at the actual fees, they're charging like 2 discount points, and then they're charging the veteran or the active duty military member like a 1.5% origination fee to do the loan. So just for context, my company, we charge a flat fee for our service. So every lender, just to kind of like get real with you, every lending institution has to charge some type of fee to be profitable. So if you are working with like a bank, like a big bank, like Wells Fargo, Bank of America, or if you're working with a credit union, sometimes they will waive this fee. The reason they do that is because they make a shitload of money on you over the long duration that you like service that loan with them. However, if you're working with somebody who's a little bit more lean, and who's much more personalized, like somebody like me, for example, my company has to charge some type of fee to turn a profit and to keep their doors open. But with that being said, some of the things I see every day are quite predatory. So I see that somebody will send me a loan estimate and literally the origination fee is like 1.5% of the loan amount. So what that means is if you have a $200,000 loan, if somebody's charging you 1.5%, that's $3,000. But if let's say you have a $600,000 loan, 1.5% is $9,000. Whatever. My company, we charge a flat fee. So I'm a big candidate of having a flat fee model. So I live in North Carolina in particular. So our rate for every loan that I do is $1,500. So if you have a loan that is $750,000, it costs $1,500 to actually process a loan. If you have a loan that's $350,000, it's still $1,500. So just something to keep in mind. I think a lot of people get really caught up on the rate, but a lot of the time when the rate is really, really low compared to the market value, y'all, come on now. Think about this, right? Like the money ain't free. You ain't getting shit for free. If it says it's free and it seems too good to be true, it's most often too good to be true. Or maybe you do get a rate that's low, but like you just straight up can't get a hold of a single person. Just this past week, I've had probably, like 5 people come over to me, and now we're working together because who they initially got paired with was non-responsive, not helpful, took like 5 business days to get back to them. And like everyone who works with me, like you literally have my cell phone number. So just to keep that in mind, I want you to just be very aware that if something seems too good to be true, come on now. We all adults. We all know that if it seems too good to be true, most often it is. Okay, so Big thing I want to just talk through. I've had 5 people go under contract this week. Specifically, most of my clients, they come to me first. We look at numbers. We look at price point. We look at what you want to pay. We create a plan. We then, I have a whole list of agents that I recommend working with all up and down the East Coast. I then can pair you with an agent if you do not already have one. If you do have one, then we sync up and we strategize. In most places that I am helping people, we are still able to leverage seller credits in this market. Now, granted, there are some pockets up and down or just everywhere where we are still seeing bidding wars and we are still seeing like people going over asking price and multiple cash off. That is still happening in some places in the country. A lot of the places that I am personally licensed in, again, up and down the East Coast, not as prominent right now. So huge thing that I really encourage everyone to look at. So there's typically 2 like buckets, okay, that people care about. Bucket 1 is like total cash to close. So literally, you may be limited on the cash that you have available to purchase a home. Other bucket is that you are much more sensitive to the monthly payment that you have to make. So like maybe you've been working and building up a big savings or maybe you're selling your home and you've built equity in that home. And if you have been used to a 2 to 3% interest rate and now we're moving to a 6 to 7% interest rate, that's going to be obviously a different adjustment, not only based on the price point, but based on the rate. So maybe you are more sensitive or care more about the monthly payment. So typically when I work with my clients, we kind of pick one to focus. Y'all, come on now. Let's be real. You can't have your cake and eat it too. And if so, there's some repercussions of having both. I say that. I'm actually for real talking about having cake and eating it too. Okay. So what I typically want you to think about is like, if you had to move one lever over the other, like which one is more important? Do you really are you stressed more about the cash needed to buy the home, or are you stressed more about the ongoing monthly payment? You clearly need to have both into consideration, but typically most people have one of those 2 that are like more impactful. So if you are someone who the cash to close is your biggest grief or your biggest concern. Y'all, I've done a whole series about how I'm not super in love with down payment assistance programs at the moment because it often prohibits people from being able to refinance in a short time frame. So if you have enough money, so this is what I would say. And right now, in a perfect world, I would recommend that most people try to avoid down payment assistance programs if they can, and to instead have enough money saved up to pay your down payment, but to really leverage a great agent who can then put in an offer with you for you to then get the sellers to pay for your closing costs. Here's the thing though, the way that you make that happen is you have to likely, so this is what I've done, literally four times this week, once last week. We all 5 in the past 7 days, this has come to fruition. So all of my clients at the moment, not all, but these 5 specifically over the past week, biggest hurdle, biggest worry is cash to close. So they are not as worried about saving $50 to $100 on the monthly payment, but they are more worried about, I don't want to spend a ton of money out of pocket because of whatever the reason being. Best strategy to get the sellers to pay for your closing cost is to go in at list price or pretty dang well near, and to, instead of asking them to come off of the purchase price, to ask them to pay for the maximum seller concession, aka to cover your closing costs. Depending on the type of loan that you use, there's different maximums. So like a conventional loan has a specific seller credit maximum, VA loan has a specific seller credit maximum, a FHA loan has a specific credit maximum from the seller. So what you want to do is be aligned with an agent. So literally just yesterday, talked to one of my agents. We came up with a whole game plan, and that's the offer that they put in, and that's the offer that got accepted. That's a huge thing that I do with so when we work together, and then whenever like your agent is involved, you really want a lender who's strategic and who can advise your agent on the best strategy from an offer perspective to make sure that you are taken care of. So if you are looking to buy in 2025 and you know that you need somebody strategic on your side, I would love to support you. As always, my comments are open for questions. If you live on the East Coast and you're looking to buy this, link on my profile for a connection form request, fill that out and I will text you. All right, y'all. See you tomorrow.